Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 1st, 2024. It is 2:10 p.m. Eastern Time as I'm starting the video. So we have about just under 2 hours to go in the trading day. Again, a reminder, Apple, Amazon, and Meta tonight after the close. Strap in and prepare for, probably some more volatility, most likely. Obviously, that can go either way. It can go up, it can go down, or it can go up and down. What I'm going to do in this video is quickly touch on the big three briefly. That's the major currencies, the dollar and the euro, Forex pair, the Treasury bonds or interest rates, and we use Treasuries as a proxy there, and of course the equity market. And then I do want to highlight a sector. I was this far. I'm doing a little pinch thing with my fingers from covering yesterday, but I was trying to keep the video. The videos get pretty long and I try to keep them intact. But I need to point this out because I think whether it's trading ops that I can highlight in this video for you, more so what's going on in the market. And that's going to be the life insurance sector. Oh, and I'd be remiss not to point out the regional banks and even some of the bigger banks. So that all kind of ties in there in the financial sector. So let's just start here. There's the euro US dollar. We did hit that. We had a little more downside today, and I haven't touched this line. That's why I had it yesterday. Yeah, perfect little tag. So that's one reason I wanted to reiterate my near-term bullish outlook for a bounce off the, in the markets. I gave you the screenshot in the comment section, showing, where we'd go down to and bounce. And we've had a bounce, and the $1 million question is over. Before this video earlier today, I gave you my thoughts. I revised my preferred bounce target. We could certainly go higher. That's why I leave those little dotted, less bright arrows. Those are always alternative scenarios. Anything more than that is just wrong. But the range is very tight. It's not like, oh, we're going to go up or down. It's clear we'd hit the trend line, go up. It's just a matter of how far up we go, and then of course, we could go a lot higher than that, and it just kind of changes things a little bit. But all right, so I have to point this out. This is, again, a trend line I've been targeting for months now. We had this divergent high, and it's the primary trend line off the lows. Remember the euro and bottom, the dollar peaked back here in September, late September. And once the market got the memo, remember, the reason I do this, if it was perfectly always day-to-day, tick-by-tick, positive correlation here, there would be very little useful value or, predictive value. It's like trying to, track QQ and the Nasdaq 100 and QQQ. It's tracking ETF. They're going to go up and down together. But what we can look for here, and I've done this quite a bit lately, talk about divergences between the two in a game of catch-up or mean reversion. So that's what happened back here. You can see that is late September, and it was mid-October when the markets bottomed. And so once it became clear, in other words, stocks were still falling into October, but yet we had started a new uptrend here in the euro, which meant a downtrend in the dollar or uptrend in the ER USD. Okay, so that marked a major bottom, and it wasn't just a random uptrend. It was big positive divergence, oversold conditions. You can see everything down here. And anywho, so we come full circle. I just want to say that is the trend line off that major low. We had quite a few reactions there in this one here. Now, there's no guarantee I expected at minimum at least a reaction off there. That's what I call reaction. When you're going down to something, you hit it, and you either bounce or consolidate and trade on it for a while. Now, if we break it, obviously that's bearish. Support is support until unless broken is what I like to say often. And so that's it. So, and again, the takeaway here is that there are periods, and you can even see a period of ultimately we might disconnect even more from the current positive correlation between the euro and the stock market, meaning they both go up and down together. But it's worth pointing out because, again, a rising euro, should we continue to rally off this trend line and even mark the end of that pullback, then all I can say is that would be a net positive or a net tailwind for the stock market. Now, a net tailwind or net positive doesn't guarantee something is going to go up. It just means it's one factor that would likely either make it go up or go down less. And the takeaway here, the reason most likely is for this. It's the same reason gold I talk about all the time. If the euro's going up, the dollar's going down. When the dollar goes down, it takes more dollars to buy a share of gold, and that's why gold tends to go up when the dollar falls. And it takes more dollars to buy a share of Apple. So whatever reasons, the correlations is there. I showed it many times in the past. Jump down to the okay, I had to stop the video there, take about a 10-minute phone call. I believe I was here talking about the euro. I just wanted to jump down to the 60-minute chart. We've had this divergence building. And I always say divergence in itself is not a buy signal. It's merely an indication that a trend reversal is likely, and so far. So the takeaway is here, it's pretty big divergence, and there's a potential for a decent trend reversal, i.e. a decent rally. We were short, either really not trading the euro, not me particularly. I use it to align trades in the stock market and gold and silver primarily, but off this divergent high, and I gave two targets. Oh no, that first, I guess one target zone on the 60. That's what it was, on the 60-minute chart. And that was a target zone that was hit, and we bounced off it. So it helped to validate it. Again, it was there in advance, hit it, had a little divergent low, we bounced. But the point is, there's been a lot of reactions along there, and including this one here. So I just tweaked that trend line. So this is kind of what I see is a zone of resistance. Remember, support once broken becomes resistance, and the downtrend line here. And should that clear, you can see next target's up here all the way at about 109.99. We'll call that 110. It's right about 110. The euro goes up to the fifth decimal there. The currencies, the forex do. And again, that's 60-minute charts. So, what are the implications on the daily? Well, I don't think it would go that far. I like to look for a major trend change. I'd like to see, at least down to the 30 level on the RSI oversold, or very close to that. And you can see that's where a lot of the major bottoms came from, right there and there. And then also, if possible, positive divergence, but not always necessary. Either way, that's all I can tell you. The euro hit support today to the button at the lows, that trend line. So far, it has reversed along with the stock market. And I gave you that downtrend line a second ago on the 60-minute chart. So watch that. And so this is where, going forward, I'll be flexible. Obviously, how the market reacts to Apple, Amazon, and Microsoft will be a big factor. My takeaway, I'll go home. I'm going to, already made the decision based on a lot of other things I'm going to get to in this video. I'm going to go home with a mild short position, swing short, but nothing crazy. Room to add or subtract, meaning close out if I don't like what I see, or things just rip the other way. But I will continue to monitor this for the bearish case optimally, not absolutely necessary, but optimally. We'll take out this trend line, whether we bounce a little more first or not. And or the other thing, maybe we start to see a disconnect between that strong correlation between the stock and the bond market, or stock market and currencies. Somebody asked me about TLT today in one of the comment sections, and my reply, and I put the chart up for them. This was TLT. Remember, we were long here right off the lows. We went long on this bullish falling wedge breakout. It was posted as a setup even in advance of the breakout. Then we got it the next day, or that day we broke out and we swung it up. So I gave two targets for swing traders. A longer term. The original trade was based off the 60-minute chart, and then the next day I followed up, or the second day, with some targets. So you can see this was really good support, this level here at 98.83 on TLT. Now that's the 30-year. A lot of the markets really focus on the 10-year. 30-year is important. You also have a bullish PPO crossover. So we could carry higher. The thing is, it has to break that level. And my reply in there, I don't have a strong opinion. This is about what I can tell you. It hit resistance today. I expected a pullback off the initial tag, and that's what we have when I roll tight. You can see the candle. So the skinny part, the wick, means we got up to that level, then reversed. I don't have any positions in treasuries, and nor do I have strong convictions right now. and they do impact the market. You can see this is the 10-year. Again, if you're going to watch just one, I like to trade TLT for the juice. I often say that. It's same reason I don't typically trade gold. If I'm bullish on gold, I'm either going to trade, if I want to use ETFs, I'll use GDX because it's going to go up or down in a multiplier of gold, or silver, which is also goes in the same direction typically, but just more up and down, more in percentage terms during the rallies and corrections. So what I can tell you now on the 10-year, we have now equal or slightly higher highs in price with lower lows in the indicators. Certainly room to go up a little more. In fact, we have some minor resistance right here where I'm putting the crosshairs a little higher. I'll put a line there. But the next big resistance, the level I've had for a while on the chart, is about 98.30. So in my opinion, that's about the max upside from today where we were. That's only about a little over 1% to that upper resistance level there, 98.30. With that first one there, about 97.50 is only 0.4% higher. So if that divergence plays out, remember divergence is not a sell signal, but it increases the likelihood of a trend reversal, especially when you run into resistance there. So, and we'll watch that. If you recall, for last several months now, heading into year end, my longer term analysis on the treasuries on yields is that we've seen a very strong correlation between the stock market and bond prices or yields, which are inverse. This is TNX, the 10-year treasury yield. So we had on this weekly chart, we had this right here. This was the peak of that beautiful, beautiful uptrend line, big giant wedge, again on a weekly chart. This took years to build. It comes off the COVID lows right here, lots of clean reactions, and that was one reason. Remember, when yields fall, like they did here, bonds go up, and that was one of the many reasons I was very long and aggressively long and bullish bonds on that recent run up. But since then, I'm kind of here's what I see in the charts. This is a potential drop there, potential little flagging action. We could come down there, and it almost seems that's the most likely path to me. Again, my convictions aren't super high, but based on these big divergences, everything else. And here's the thing. Now, normally, and it has been, falling yields equate to rising stock prices. Stock market and the economy loves low rates. However, and that's what we've seen so far, and it's been tick by tick. This is where the market really became in 2022. It became hypersensitive to the rise in rates. Here it was dismissive of it, and that's where Powell and the Fed was dismissive, saying, inflation's transitory, blah, blah, blah. Then it became hypersensitive, especially when we broke out here. So lately, this has been kind of chalked up by the market. It's this drop in yields. We had a little kickback, I should say. They kind of shrugged that one off into year end right there. And we may see, if we do see yields fall, again, normally it would be net bullish for equities. And you'll just have to watch the stock market and see how the stock market's reacting there and how everything else. I'm going to get to a few other things in this video that will impact where the market's likely going to go. But I've been talking about where I started on a minute ago is towards the end of last year, I talked about a scenario where I can see kind of a handoff or a change between that hypersensitivity interest rates, where rates may continue to fall, but also the stock market then falls, and these rates would be falling as a bid to safety. In other words, if the stock market starts to roll over and starts to come under some pretty intense selling pressure, then you're likely to see institutions move into the safe harbor. In other words, they buy bonds. When you buy a bond, bond prices go up because there's buying pressure on the bonds. More buyers and sellers causes any security to go up. And rising bond prices mean falling yields. So that's what I've been talking about. So that's why I'm a little bit wishy-washy on bonds, and I'm not so married to if we look like yields are going to drop, that means the stock market's going to rally. It's been the trend for a while, but at some point we may see that kind of disconnect there. I'll continue to update those, and as of now, you can see Like I said, if yields continue to move lower and bonds continue to rally, that's a very, and let me repeat, a very good support level for the 10-year bond yield, about 3.33%. And so if we get there, and the charts indicate, I'll be looking to short treasuries because we'll probably see an uptick in yields. Okay, let's get to all the other stuff here quickly. Talk about the equity markets. There's that beautiful little uptrend line again, 60-minute uptrend line. We fell to it, hit it to the button. You had another chance if you missed it yesterday. Again, after the market, we had a pullback in equities right here. This is a 1-minute chart. So we opened up right here. And then I got that post out to you this morning around 10 a.m. after the market. I started putting together and then got it out to you there. So nothing huge, but we went up, and that's where we hit that my bounce target there. So 0.8%. And there was a pullback to be made there. That's I corrected my post. I said I had made 2 in and out trades. It was actually 1 before I reversed right here. That was on this, and that was because you had that 5-minute chart, and then also on the futures. I'll get to that in a second. So here's where we're at. This is a chart I gave you both this morning. The 5-minute chart. Remember, I gave you several. There were 60-minute charts in there of NQ and QQQ in this 5-minute chart. But you can see this was a trading range. Very good support right here. There's a gap right there. The bottom of gaps and the tops of gaps are also support and resistance. You had a reaction there. And so far, that's capped everything. So, I wouldn't call this an inverse head and shoulders. I know it kind of takes that form, but I don't care for much on the 5-minute chart. But you have a similar form. So maybe, if Apple beats, and I gave you, and I'm, still maintain these are potential targets. If you think there's more upside in the market, I'm going to tell you why I changed my mind right now. I'm going to segue into that. Initially, I was looking to bounce up here and possibly up for a back test of the trend line. So, and this is kind of getting into active trader stuff now, but this is a 15-minute chart. I didn't share that one, but this is one, look at all time frames, 1-minute charts, sometimes 5, 15, 30, 60s, looking for different levels. But that's where we're at now. We did take out this trend line, but remember, Apple's coming up tonight. My guess, my bet, my money is on a fade into the close. A lot of nervous profit taking. Even though Apple's already been coming down pretty hard, it's down it's one of the 2 big Mag 7 down for the year. I still think we'll see some maybe some money come out of those, especially considering the smackdown we had on some of the other Mag 7 that reported. But either way, it's good resistance. Look, if we pop it, there's your next level. There's some micro levels. I would give you a line right here, probably get a little reaction. And then if they take that, that's 17,590. If they take that out, that opens the door up there. And remember, we're coming off that divergent low. This was one reason I went long yesterday, and even added on the pullback today and came. But there it is. So I think either way, that's what I favor right now. And I also favor it's not just Apple, Amazon, and Meta. It's what's going on, which I'm about to get to in a second, in the banking sector, both regional and big banks, as well as life insurance sector. I'm going to get to that in 1 second. I just want to kind of show you this, what we're looking at here. Know that any positions held into those big companies reporting tonight, it's almost like holding into a Fed meeting. You're going to see some volatility. You're either going to be very happy or very unhappy. And what tends to happen too, if you are swinging, whether you're bullish and long or bearish and short, know that you've got not 1 but 3 companies reporting, and there's at least 2, if not 3 components to each company. You have the initial numbers come out, and the market either does, I'm just drawing it here, they either shoot spike way up or spike down, and then quite often that's just the initial reaction. It's a knee-jerk reaction. There's our algos, computers trading against each other in milliseconds. So what tends to happen, from my experience, if you're running a tight stop, they're probably going to get you one way or the other, because they're going to run it up, they're going to run it down. So that's the first component. Then comes a conference call. And sometimes I've seen stocks really explode, initially after earnings are reported, great earnings, but then when you lift up the hood and they start talking about, what they see and what kind of shenanigans were used in those earnings, as far as accounting shenanigans or their outlook. That's a big thing if they give guidance, et cetera, et cetera. And so you can see, a conference call can also build on gains or it can fade the gains. Point is, I'm just almost random, if you will. So if you are going to swing it, I like to go in with a relatively small position, one that I can add to, or I won't get clocked if it goes against me too fast, because I also like to widen my stops up or pull them completely, so I'm not taken out in that back and forth noise, because nothing's more frustrated than positioning. You think something's going here, you shorted here, and they do this, and your stop is right here, and they do this after earnings, and then that's the lasting reaction. And likewise, if you're bullish, it can go down and clip your stop, and then you're out, and then it goes the direction you thought it was going to go, and sometimes so fast you don't have a chance to get back in. And that's one other point too. Trade long enough and become unattached to it. If I've had many trades where my stops are hit and I run, and then something happens, and I can make a case to get back in the chart and re-enter that trade. You can always get back in if you realized you were taken out in a whipsaw, but you can, at that point, you can still make as good a case to be long or short the stock or the index or whatever it is. That's the 15-minute chart of NQ. Here's my 60. I'm going to tighten it up for you real quick so you can see. Again, there's that's 17,412. That was that initial bounce target yesterday. We carry higher. Right up here, you have that back test of that trend line. And then anything much more than that, 17,583 is my next resistance. And if they punch or even get close to 17,743, they're probably going to punch it and take it up to new highs. And again, it'll still be a marginal new high. I'll give you my thoughts if and when that happens. All right, now let's just talk on the, let me start with life insurance. They have, in my things to watch list, I have a couple sectors in there. I have a lot of individual stocks. So I noticed this yesterday, and I apologize. I might even have brought this up in the video. I can't remember now. I'm looking at so many things every day. If I brought it up, I apologize. If I didn't, I also apologize, because I should have. I noticed bearish engulfing candles in the sector. This is in TC2000. It's IX 1580 is the life insurance sector. Big bearish engulfing candle. Just a little sidebar. In my previous life, I was a financial advisor. I was also a licensed life insurance agent, so I was familiar with how, what they do with people's money, because, you got people putting money in, UL policies and, other things they want to know. So you can use that as an investment, and they want to know, is the money safe? And historically, now things may have changed, and, it's been decades now, a couple decades since I was doing that. But historically, and I don't think it's changed very much, most of the money, when you have a life insurance policy, the insurance company's socking away most of the premiums, the money they're taking into safe investments, primarily bonds, a lot of government bonds, some corporate bonds. So it's almost like a bond fund. So just, they're bond sensitive. They have a big portfolio of a lot of bonds, as did, the regional banks and banks in general, even big banks. And that's what caused the regional banking crisis last year, and the Fed had to come to the rescue there. So I haven't read up on what's going on. I'm sure there had to do with some earnings recently, is what I imagine. But what I'm seeing is some red flags here in the sector. First of all, bearish engulfing candle. I love me some bearish engulfing candles after a big, big uptrend like that. That is a big uptrend. Life insurance sector went up since March of 2023. It's rallied the sector 35%. Remember, this isn't tech. That's a good gain for the life insurance sector. And did it with negative divergence, just like you had that big divergent high back here. And you got that, just like you had a divergent high there. And you got all this, just like you had a divergent low, and there's the rally. And a divergent low here, and that was this rally. So I want to say the technicals were there. Again, shame on me for kind of missing the setups and not getting them out to you. But there was the bearish engulfing candle, and look, nice follow through today. Remember, one reason I love bullish and bearish engulfing candles, and again, you have to recognize them at the right place. You want to see it after a prolonged uptrend, not just anywhere randomly in the middle of a trend or a grind, a sideways move, and then they mark lasting tops or bottoms. And the thing about them, I don't know the percentage odds. It's going to vary from stock to stock, sector to sector, index to index. But I can tell you it's pretty good even if it's decent, let's just put it low. Let's say 30% chance if you short a bearish engulfing candle, it's going to play out for a major trend reversal. But the thing about it, the RR is phenomenal because you see it, you short there, you take the short before the close or the day of the close or the day after, and your stop is right above it, because if the next day's candle even goes above it, it's no longer a topping stick. And so that's the strategy I always use. So your downside or loss is very minimal compared to the upside potential, because again, this is not a day trade or an active swing, quick swing trade. This is a trend trade. You're trying to position and catch major trend. Look at that one right there. I don't know if you can see it. I didn't notice this till right now. Bearish engulfing candle right there. Remember, the S&P had a bullish engulfing at the lows. There was a bullish engulfing right there. That tail was a hair below. I'll give it a little room usually on those, but they're pretty, like I said, pretty reliable. And more so, it's all about the RR. Some trades have higher percentage likelihood of success. I'll usually tell you, not on every trade, but a lot of them I'll tell you kind of my convictions. I call it a high probability entry or high probability trade. Those are the ones I think have a high chance of playing out, but they tend to have the lower risk reward ratios. So anyway, so this is twofold. Number one, it is not too late. Again, yesterday was the day to short with big red candle today. You're at support, a reaction low right there. Traders always look at these reaction lows. We undercut it briefly during the day. So, pretty much any kickback rally, I'll tell you this right now. And again, this is not an ETF. This is the actual sector. But if the sector bounces back to about anywhere close to 3,500 or so, that would be an objective short. Let's go over some of the individual names here. I'm clicking on the component list for it, and there's MetLife. So again, I saw these yesterday, and sometimes I've had a lot going on lately. I might have mentioned one or two of these or the sector to you in that video. I don't believe so, but I saw that bearish engulfing on Met yesterday with the bearish rising wedge. Beautiful, beautiful. So you can see I created that yesterday, created in January 31st. Uptrend line wedge, boom, popped it a big pop. And it's down 6%. And that's a big move for these insurance companies. So you've got the bearish rising wedge, sell signal 1, break of the bearish rising wedge, sell signal 2. This is something to watch, because even if you don't want to short the life insurance companies, it could signify some problems within the financial sector. And don't underestimate the importance of the bond market. So let me go through a few more. Here's Aflac. A lot of these I didn't even update. I just kind of noticed I'm just tweaking my uptrend line. Bearish engulfing candle. Look at that, beautiful. And then boom, 10.5% down on Aflac. Coming up, you've got a trend line here. So, and it just hit the 200 days. So it's not really objective right now. Doesn't mean they can't keep falling lower, but it'll depend really probably what the market does. But for example, with Aflac right here, nice support about 80.23. Support once broken becomes resistance. So any kickback to that level, in fact, I don't know if that's what we already had today. No, it opened down right about there, so that would have been an objective short this morning. So I'll keep updating these. This one hasn't really run yet. MFC, Manulife, divergent high, just starting to come off that divergent high, and that's the story on a lot of these. You got the negative divergence. Sell signals on quite a few, objective short entries, bearish engulfing candles like this one here, Prudential, and so forth and so forth. The PUK, that's Prudential, that's the British shares, the ADS, American Depository Shares. So this is the American company right here. GL, Global Life, divergent high, look at that. Bearish engulfing candle, boom, sell signal 1, breakdown. That's objective, it just broke down. Obviously, you want to see it now take out that previous reaction low, or today's low would be the next objective. So you could short it here and then add a second lot or bring it to a full short after a 118.30 goes. And these guys, once they break, they tend to roll over pretty quickly. So... all right, I won't go over each and every one. The ones I'm going through these in order of market cap. So the ones I already covered are the bigger ones. This is F&G annuities. I used to be licensed to sell annuities as well. You have to have a life insurance license to sell annuities. And they're same thing. That's where they, they're steady Eddie. They stick the money in bonds, safe investments. And but you can see same story. So this one has yet to break down. All right, guys. Let me look at, did I cover Progressive already? It might not be in this list. Nope, Progressive. Bearish rising wedge, trend line right there, little gap below. If you see this, one thing I watch for is a potential island top. There's a island cluster top. You have a cluster of candles separated by a gap on both sides. Now we don't have the other gap, but if we gap down below the trend line, below the rising wedge, that would give us an island top. That's another one of my favorite topping patterns, candlestick reversal patterns. Same thing, you just short with a stop above the recent highs. Just like on an island cluster bottom, you do the same thing in reverse. Targets 164.75, then 149.62, and we'll go from there. We'll see if there's follow through in the sector. Okay, so one to watch for both individual trade ideas and the importance, potential importance to the economy and the markets. KRE regional banks, some of you probably heard, somebody mentioned it on the site as well. I noticed this the last couple of days, they've been coming down pretty hard. It wasn't a random event. It might have was, probably some earnings or something that kicked it off, but you had this beautiful downtrend line off the highs. Here's another sector, and an important sector. It's clearly in a bear market, peaked back in the beginning of 2022. And recently rallied right in, another rejection off the bear market or the primary downtrend line. What you want to do on these is, you can get, if you use TC2000, I don't know if other charting platforms have it, when you click on an ETF like KRE, it loads the components. So I'm going through the component list, not sorted by market cap now. I like to do that too, because the bigger the bank, the more important it is to really the whole financial system. But this is just, I'm sorting these by biggest losers or gainers. Let me go here. Let me reshuffle the list. So here's NYCB, New York Community Bank Corp. This is the one that kind of set the tone in the last couple of days. Big gap down. I mean, look at that. This thing got whacked 43%. So you're starting to see the cracks again. And again, there's bearish setups, bearish charts say they're probably going to go lower, divergent high. And you know what? I don't know, and I should have read up on it, and I should know this. I looked into it before that the program, I'm forgetting the name or the acronym now, and the Fed bailed out the regional banks by letting them off shelf all their Mark II maturity treasuries that they plan to hold them to maturity that were greatly underwater and still are in most cases. That was supposed to expire in March, but I remember reading it at the time. I read through the Fed's actual statement. It says, it didn't say it will expire. They have the option to extend it. And I'm sure it's been addressed. I don't know if they're extending that. But even if they do, and you see these guys falling, you can only hide those losses forever. And that's the other thing, too. If you want to know where these guys are going, if you see treasuries tick up, rates start ticking up again, the price of bonds go down, that's just more problems for them. The Fed can't support everybody forever. They're creating, number one, forget about the moral hazard, which is huge, but there's all kinds of issues with that. So best case scenario for the stock market, for the U.S. economy, especially for the banking system, financial system, is that interest rates come down substantially in the next year or so, or this year, and bond prices go back up and really put wipe out a lot of or undo a lot of the big losses on their books, because those losses right now are really just been transferred over to the Fed. And there's big divergent low. I just had to look at that beautiful little reversal candle right there. There's an island bottom candlestick right there. Reversal, gap down, gap up, separated gaps, never violated that candle. That's a great bottoming stick right there. Anyways, so and break under today's lows should do the trick for this one. Keep an eye on these guys. I'm not going to go over each and every one, but you can see those that really haven't come down hard yet look like they're going to continue down, like this one, WAL, Western Alliance. Nice divergent high. I could put a little trend line right here and break down, but it hits support, bounced. Just keep an eye on the sector. And then the other things is, what did I read about? I'm going from memory now this morning. one of the big international banks, ING, I believe it was, down big, talking about they have to, I think, and again, I'm going from memory. I sometimes just scan articles, scan headlines. I think they need to increase their, they understated, they're restating their profitability targets. Now they don't expect to be profitable till, 20, it's going to be a ways out now when they were expecting to be profitable now or this year. The other thing is they had to increase their loss reserves for their U.S. Real estate holdings. They have a lot of office properties and things like that by 4 times, expecting some bigger losses coming up in the real estate sector. That problem's not over. So either way, you're coming off overbought conditions and even, about equal highs there on the indicators, a little bit lower high on the PPO, so big divergent high. Remember, we had this wedge right here, and back then, I guess that was, when did I give you that? Back in September 5th when it broke down, or before it broke down. That's the wedge measured target. And we certainly, if you shorted that and you were targeting this, then you wouldn't be stopped out. That's well within an attractive 2 or 3 to 1 RR, targeting a drop to 1050 if you shorted the breakdown of the wedge. So that one will probably still play out in my opinion. And the takeaway, if it does, these are the banks. This is JP Morgan, divergence. This is just a matter of time. Look at that. Right on the line today. It almost broke down from that little minor trend line. Bank America, divergent high, breakdown, sell signal, objective short today. But, it had support, a lot of these banks. So there's your next. You either short it on a bounce back, on a back test of the wedge, or you wait for a break below this 3284 support. So that's what the banks look like. They're rolling over, guys. So right now everybody's talking about tech, or most people are talking about tech, and we'll see tonight where that goes. But look at the move down. So for Wells Fargo, coming off that divergent high very impulsively, and I could go on and on and on. Oh, we got one subscriber that is asking me for a lot more frequent updates on the semis, so I'll be glad to do. So far, so good. That one was highlighted. That one I did get on the bearish engulfing candle, the reversal top right there. And so far, we've moved down. Now we're at trendline support. So not by mere coincidence, QQQ. Let me take away everything here. It's a little muddled. There's your trend line off of the October lows right there. Trend line I've been showing you on QQQ, and that's what you have on SOX as well. So, obviously SOX are semiconductors are technology stocks. Technology is the largest sector of the Nasdaq 100. So birds of a feather flock together. This is what you want to see if you're a bear, and if you are a bull, and I know there's some out there, and more power to you. This is where you buy. You don't buy, a big, rip that looks like a blow off top, or you don't buy a bearish engulfing candle. First of all, those do typically mark lasting tops. But what you do buy, if you don't think that's going to play out, or the divergences won't matter, then you buy pullbacks to support. If you are bullish and you don't buy this, and you have a reaction high as well, let me turn on the lines on. Let me move this one up. What I wanted to do here is cover this reaction high, these 2 candles there, and that's where we're at now. Next support's right here, about 567, and then so forth and so on. But the takeaway is, from an objective point of view, there's only one objective trade to be made right now in the semis, and that is long. It's not the trade I'm taking. I don't recommend anything. I point out things. So far a reaction, in the sense I define a reaction when you're falling down to a support level. A reaction is either a bounce when you hit it, or consolidation. So far we've traded 2 days there. So what is objective if you are bearish? Again, if you're bullish, you go long here and you put a stop below. It's easy, right? It's super easy. Stop somewhat below, ideally on a daily closing basis if you're trading on the daily chart. And if you're bearish, whether you bounce first or not, you wait for a break of the trend line. There's your objective short entry. You could also have an objective short entry if you are looking to short the semis or add to a short position. There's a big old gap right there. So any bounce to that gap, you could also throw on a short position there with a stop somewhat above the top of the gap. And then maybe add on a break below the trend line. Okay, I'm going to cap it here. It's almost 3 o'clock now. We've got an hour to go, so this video will get out to you in time. And again, anything that happens between now and 4 p.m. probably doesn't matter. What's going to matter is what happens after hours today, and then how, especially tomorrow when the big boys, the institutions, step onto the field. If they like what the big three that are reporting tonight are selling, new highs are pretty much within spitting distance for the semis as well as especially the Nasdaq 100, but any new high will still be divergent high. So this is just me. It's not a breakout I'd be chasing. In fact, it's a breakout I'd give a little more room to allow for one more potential thrust up. That's if I decide, I'm an active trader. If I decide 30 seconds to cover, the modest short position I'm going to take home, no big deal. I can always add it back, tomorrow or later up here on a higher level with, if we get another sell signal or any objective reason to short. All right, let me stop there. And then there's everything else, and I'll cover those in another video. And like I said, next week, whether this market, if it shows us its hand clearly, whether it wants to continue up or whether it wants to start moving down impulsively, I'll get some more individual trade ideas. I'll start looking for some other things. I've been covering a lot of the same, using that whole asset allocation model, commodities, metals, bonds in the stock market. I've been mostly focusing on, but I do introduce individual stocks and sectors, throughout these videos. And so I think there's enough trade ideas out there for you now. And as always, if you see something else you want me to cover or give a second opinion on, throw it in the comments section. I'll be glad to do so. Okay, this has been Randy Finney with Right Side of the Chart. Have a great day.